You've probably heard the old Wall Street saying, "Sell in May and go away." It's one of those phrases that gets tossed around every spring, echoing through trading floors and financial news headlines. But what does it really mean, and where did it come from? The idea is simple. Sell your stocks at the start of May and stay out of the market until the fall, supposedly to avoid the historically weaker returns that often occur during the summer months. The theory suggests that by stepping aside, investors can dodge the seasonal slump and return in autumn when the market is believed to pick up again. This advice actually dates back centuries, to a time when London brokers would leave the city for the summer social season. With so many traders away, trading activity would slow dramatically, and prices often stagnated or drifted lower. Over time, this seasonal pattern became folk wisdom for investors everywhere. It promised a stress-free summer, free from the anxiety of market volatility, and the chance to enjoy life while the markets supposedly took a break. But does this old saying still hold up in today's fast-paced, interconnected, and global markets? The financial world has changed dramatically since those early days. With instant access to information, 24/7 trading, and markets that never really sleep, the world of investing is more dynamic than ever before. News travels instantly, and opportunities can appear or disappear in a matter of seconds. Relying on centuries-old advice without checking the facts could mean missing out on gains, or even making costly mistakes. The market's behavior is shaped by countless factors today, from global events to technology and investor sentiment. Still, many investors get nervous as May approaches, wondering if they should sell to protect their profits or ride out the summer months. The old saying lingers, creating uncertainty and debate every year. But before making any big moves, it's crucial to look at the actual data and understand what history really shows. Blindly following tradition can be risky. Is selling in May a smart, data-driven strategy, or just an outdated myth that no longer fits our modern markets? The answer might surprise you. Let's dig into the numbers, examine the evidence, and find out what really happens when investors sell in May and go away. Historical data gives some support to the old adage, "Sell in May and go away," at least at first glance. This saying has echoed through trading floors and investment circles for decades, hinting at a seasonal pattern in the stock market that many investors still watch closely today. Bank of America analyzed S&P 500 returns all the way back to 1928, and found that the period from May to October is, on average, the weakest stretch for stocks. This isn't just a recent trend. It's a pattern that's persisted for nearly a century. The average return from May through October is about 2.4%. That's a modest gain, especially when you consider the risks and volatility that can come with investing during these months. Now, compare that to the period from November through April, which averages a much stronger 5.2% return, more than double the summer months. This dramatic difference has fueled the popularity of the saying and shaped investor behavior for generations. This stark contrast between the two seasons explains why the saying has stuck around for so long. It's become a kind of market folklore, passed down as a warning and a strategy. It paints a vivid picture of a market with a seasonal rhythm, cold months bringing the heat, while warm months seem to cool off. The idea is simple. Timing matters, and the calendar might hold clues to market performance, but averages can hide important details. Beneath the surface, the market's story is far more nuanced than a simple seasonal split. The story isn't as simple as it seems. There are years when the summer months outperform expectations, and winters that disappoint. Not every summer is weak and not every winter is strong. Market performance can swing wildly from year to year, defying the averages and challenging conventional wisdom. Before jumping to conclusions or making big investment moves, we need to dig deeper into what's really happening during those so-called weak months. Context, timing, and other factors all play a role. Is the entire May to October period truly a danger zone for investors? Or is that just a myth that's grown over time? There's more to the story than meets the eye. Let's break it down and see what the data really tells us. Bank of America didn't stop at averages. They looked closer at the May to October stretch. They found the weakness isn't spread evenly, it's back-end loaded. Most of the trouble comes in August, September, and October, not the early summer. So, selling in May could mean missing out on gains in June and July. Their new advice? Sell in August and buy Halloween. This approach targets the real weak spot, not the whole summer. It's a reminder that simple rules can miss the nuances hidden in the data. Investors who sell in May are acting on incomplete information. Understanding which months are truly risky is key to smarter decisions. Let's break down the summer even further. June through August is actually the second strongest 3-month period of the year for the S&P 500. The average return during this window is 3.3%, better than the full May to October average. If you sell in May, you'd miss out on these gains. The real trouble comes from August through October, which is historically the weakest stretch, averaging nearly flat returns. All the underperformance is concentrated in late summer and early fall. So, a more targeted strategy would be to stay invested through early summer, then consider reducing exposure as August approaches. Lumping all summer months together is misleading. The data calls for precision, not blanket rules. The S&P 500 isn't the whole market. What about tech and small cap stocks? The Nasdaq 100, heavy with tech, has historically done well in May, averaging a 2.19% gain and rising 68% of the time. Selling in May would mean missing out on these gains. The Russell 2000, tracking small companies, also tends to perform well in May, rising 64% of the time with a 1.33% average gain. For tech and small cap investors, May is often a month of opportunity, not risk. This shows the danger of applying one rule to all sectors. Different parts of the market have unique seasonal patterns. A diversified portfolio may not benefit from the sell in May rule at all. Understanding what you own is crucial. Broad adages rarely fit every investment. There's another twist: the 4-year U.S. presidential cycle. In the second year of a president's term, May's usual strength for tech and small caps often disappears. The Nasdaq 100's average May gain drops to just 0.53%, rising only half the time. The Russell 2000 actually loses ground in May during these years, down 1% on average. Political cycles can override seasonal trends, but even these patterns aren't guarantees. 2018, a second year, saw both indexes rise in May. The market is influenced by many factors, not just the calendar. Relying on a single indicator is risky. Patterns can shift or break at any time. Flexibility and context matter more than catchy rules. Seasonality isn't just for stocks. The US dollar has its own patterns. May is historically a strong month for the dollar, especially against currencies like the pound, real, peso, rand, and rupee. For international investors, a stronger dollar can reduce the value of foreign profits. This seasonal strength holds even in presidential cycle years. The drivers may be different: global capital flows, interest rates, or macro trends. It's a reminder that seasonality exists, but each asset class is unique. Knowing these patterns can help manage currency risk. But, as always, no pattern is foolproof. Look at each asset individually before making moves. Sell in May is really about market timing, trying to get out before a drop and back in before a rally. In theory, it sounds perfect. In reality, it's nearly impossible to do consistently. You have to be right twice: when to sell and when to buy back in. Miss either call, and you risk missing the market's best days, which often cluster near its worst. Missing just a few strong days can devastate long-term returns. Most people who try market timing end up worse off than if they'd just stayed invested. The buy and hold approach, riding out the ups and downs, has historically worked better for most investors. It doesn't require predicting the future. Over time, the market tends to rise, rewarding patience. Staying invested ensures you capture the gains when they come. It's less exciting, but far more effective. After looking at all the evidence, it's clear that the old adage, sell in May and go away, is an oversimplification of how the markets really work. While it's a catchy phrase that's been repeated for decades, the reality is far more nuanced and complex. The May to October period isn't consistently weak, and selling in May often means missing out on gains that can occur during the summer months. In fact, there have been many years where the market has performed strongly during this time, leaving those who followed the rule on the sidelines. For tech and small-cap stocks, May is frequently a strong month. These sectors often see innovation and growth stories play out in the summer, which can drive prices higher and reward patient investors. The real period of concern historically is August to October, when volatility tends to spike and markets can become more unpredictable. It's not the entire summer that's risky, but rather these late summer and early fall months. A more nuanced approach, staying invested through early summer, then getting defensive or rebalancing in August, fits the data better and can help investors avoid unnecessary missed opportunities. For most long-term investors, ignoring the saying and sticking to a disciplined investment plan is the best move. Over time, staying invested has proven to be far more effective than trying to time the market based on seasonal trends. Market timing based on catchy phrases is risky and often costly. Emotional decisions and attempts to outsmart the market can lead to missed gains and increased stress. If sell in May really worked as a foolproof strategy, everyone would do it, and the pattern would quickly disappear as markets adjusted. Building wealth is about time in the market, not timing the market. The most successful investors focus on long-term growth, not short-term seasonal patterns. Stick to your plan, stay diversified, and invest for the long run. Diversification and patience are your best allies in building lasting wealth. So, when you hear sell in May this year, remember, it's more of a history lesson than real investment advice. Focus on your goals, not on old market myths.